So welcome back, everybody, to another webinar organized by Princeton for everyone worldwide. We're very happy to have John Campbell with us from Harvard University this week. Hi, John. Good to see you.
Hi, Markus. Great to be here.
Thanks a lot, John. John will talk about mortgage choice and monetary policy. What are the implications of different mortgage markets on the monetary policy transmission mechanism? And before we go to John, let me just give a few opening remarks and summarize also the poll questions you gratefully filled out. So the first question was, do you have a mortgage? And if so, do you have a fixed rate mortgage or an adjustable rate mortgage? And the answers were, a large fraction of the people don't have a mortgage. 58% have no mortgage. 31% have a fixed rate mortgage, and 11% have an adjustable rate mortgage. Of course, John would like to know which country you're in, because probably determines that, but we were not able to differentiate this at this stage. The second question was, how does a mortgage system with adjustable rate mortgages affect the transmission mechanism of monetary policy? Do you think it's stronger, weaker, or no difference? And 78% thought it's stronger, 7% thought it's is weaker, and 15% thought it makes no difference. The third question is, and that's US focused, does the government securitization activity through the GSE, the government-sponsored enterprises, for conforming fixed rate mortgages increase the fixed rate mortgage share in the US, yes or no? And the answer was 80-20, so 80% said yes. And finally, in an environment of increasing interest rates, fixed rate mortgages, borrowers pay an increased mortgage cost when they try to move. So you lose, essentially, you have an advantage from a low interest rate mortgage, and you give it up if you have to move. And does this lock-in effect make it less or significantly more likely not to move in another location, to take on another job, and so forth? And 78% thought, yes, the lock-in effect will actually reduce labor mobility across regions. And 28% thought, no, it will not affect labor mobility. So let me give a few thoughts, and then we pass on the floor to John. So here, if you think about monetary policy, if you change the interest rate, if the central bank is changing the interest rates, there's, of course, a substitution effect and an income effect. There's also an endowment effect, essentially. But the income effect is really distributive. It affects different, in a model with heterogeneous agents, affects different borrowers and savers differently. And this has two implications. One, which is very much focused by the Henk literature, by the heterogeneous agents, New Keynesian models. It has an aggregate demand effect. So savers which have a high marginal propensity to consume are affected differently than savers or borrowers with a low marginal propensity to consume. They affect the consumption, aggregate consumption differently. And Tobin pointed this out already, or Claire did recent some important work. My former colleague Arlene Wong did some important work on this as well, affecting the aggregate demand management through interest rate changes. But you also have an income effect. It also affects the balance sheets of various players through the income effect, and that affects then also the risk premium in what the price of risk is and how the risk moves around. That affects households and banks as well. And the question is, who is affected more, the households or the banks? And that depends very much on the structure of the mortgage market as well. So even if the marginal propensity to consume is the same across all the players in the economy or households in the economy, there will be some shifts here as well, because some players or some agents in the economy will be more constrained than others, and then they might be more essential for certain financial intermediation. So one way to see how the difference will play out is when the interest rate goes up. If you have adjustable rate mortgages, it hits the households, in particular indebted households, directly. There is less credit demand. If you have fixed rate mortgages and it's given, the mortgages are given by the banks, then the banks are hit. And then the banks will be undercapitalized potentially, and they're cut back on credit supply. So one is much more credit demand channel, the other one is credit supply. Of course, the second channel depends very much how much market power the banks have on the deposit side. And we see this play out dramatically also recently with the Silicon Valley Bank and other banks. The market power on the deposit market shields the banks as long as there's no run on these banks. And if they can pay the policy rate is going up, but the deposit rate is staying low. Finally, it also has some very regional difference, and that's, I think, what John will allude to. In the United States, the situation is very asymmetric. If you hike the interest rates, it will hit the banks. If you lower the interest rate, it favors the households. So I think it's very US specific that, you know, in one direction, it's affecting the banks, in the other direction, it's affecting more the households. And my main question, I will probably come back to that, is if you have a currency area where different countries in the currency area have different structures of the mortgage markets, how to make monetary policy? It makes monetary policy more challenging. And how do you take this into account? And can you somehow compensate this if you do some asset purchases in order to balance these two channels that, you know, some members of your currency area or some countries in your currency area have a different structure mortgage market and you affect essentially the transmission mechanism differently? Or one could go even so far that one would say that it might not be an optimal currency area if the mortgage markets are different. So with this few opening remarks, I'll pass on the floor to John, who will know way more and has looked at many, many data as well, and he will enlighten us how this is. I think it's one of the most important elements to understand the monetary transmission mechanism. So John, the floor is yours, and we're looking forward to your
Okay, thank you very much, Markus. Let me share the screen, and hopefully we can get this going nicely. Okay, so nicely visible, the opening slide. So I want to start by saying how important mortgages are. Now, the poll results were perhaps a little atypical because almost 60% of the people listening to this webinar don't have a mortgage. But that's because this is an unusually wealthy and elderly audience. Mortgages are, of course, the largest household liability in the US, more than half the debt of a typical household. And that's also true in most other developed countries. Less so in countries like Germany, where there's a low home ownership rate. But in most places, mortgages are the big liability that a household has. Mortgage rates, of course, as Markus mentioned, are also the main direct channel through which monetary policy affects household consumption. Very obviously, mortgage rates have a strong impact on the rate of home building and the construction industry. And problems with mortgage lending were at the heart of the global financial crisis and are again very salient as we see US regional banks failing, in part because of their large mortgage portfolios. Now, in the US, what's the US mortgage system? Those of us who are based here know it very well. The standard mortgage is a 30-year amortizing nominal fixed rate mortgage, or FRM, firm for short, with a refinancing option. When rates fall, you can refinance. When you do that, that's treated as a new loan origination, so you have to go through a check for your income, credit score, home equity, etc. Adjustable rate mortgages, or ARMs for short, are also available in the US, but the market share of ARMs in this country is typically low, with occasional spikes. Now, another feature of the mortgage system that I will emphasize is the so-called points system, whereby borrowers can borrow a little extra to cover the closing costs, the transactions costs of buying a house, without affecting their mortgage balance by paying a higher mortgage rate. Then a final important point is that US mortgages are typically not assumable. If you move, you can't pass your mortgage on to the new home buyer. Mortgages are also not portable. You can't take your mortgage with you. Now, there is an exception, which is that certain government-backed mortgages are in fact assumable, but that's a minority. That's only going to be about 10% of the US mortgage market. Now, I want to emphasize that the US system is an outlier internationally. It is very unusual. So there are, of course, many countries that rely basically on adjustable rate mortgages, where the rate is fixed for an initial period that might be 1 year, might be 2 years, won't be more than 5 years. Germany has fixed rate mortgages, but without a refinancing option. And the closest international parallel to the US is probably Denmark, which is a country I've studied in some detail. Denmark has both ARMs and FRMs, and the firms have a refinancing option. But there are some interesting design features of their system. For example, in Denmark, the option to refinance is an absolute right to do so, so long as you're not extracting equity. So it doesn't depend on your income, your credit score, or your home equity. When you refinance, you can do so either at market value or face value, whichever is more advantageous to the borrower. Mortgages are typically assumable, there are no points, and then they fund it differently. The funding system relies on covered bonds. So I'll come back to that as we go through. Now, what I want to do is be a little bit unfair, and I want to present a prosecution case against the US mortgage system. It is conventional in this country for financiers and politicians to boast about how wonderful our mortgage system is, one of the wonders of the world, et cetera, et cetera. But I want to present the prosecution case. So I'm going to emphasize 4 problems that the US system has. The first is that the mortgage channel of monetary transmission is weak. So it makes it harder, life gets harder for the Fed. The second is that US refinancing rules worsen inequality because lower income and less sophisticated borrowers are less able and less aware that they need to refinance, and they end up paying higher rates. A third problem is that fixed rate mortgages have long duration, they're long-term bonds, but also that duration is very variable because of refinancing behavior. And that can destabilize the financial system, which in turn can constrain monetary policy. Finally, I want to show you evidence of lock-in effects that when rates go up, people with old mortgages will have to give up those mortgages if they move. That can reduce housing market liquidity and labor mobility. And I think these are all 4 really quite important disadvantages of the current US system.
Will you mention some advantages too? Oh.
Well, I mean, certainly towards the end, I want to talk about what borrowers like. And, you know, there's a sense in which when you look across countries, borrowers tend to like whatever they're used to. Mm-hmm. But certainly borrowers in this country are very comfortable with fixed rate mortgages. Households like the insurance that they're buying against increases in their interest rates and their monthly payments. And so that's a point I will get to at the end. For most of the talk, the beginning part of the talk, I'll just sort of hover in a helicopter over the system and talk about the systemic aspects of it. But then we do need to come back down to ground level at the end and ask what people are actually interested in buying. So I'll go through these 4 problems in turn. Then I'll talk about some of the evidence on borrower preferences, and then conclude with some policy suggestions. Okay, so first of all, the mortgage channel of monetary transmission. Markus gave a really nice introduction to that. This channel is not about intertemporal substitution. It's not the new Keynesian Euler equation, you know, that we talk about when we write down new Keynesian models. It's about redistribution across agents. A point made years ago by Tobin and much more recently by Adrian Auclair. So, you know, when the mortgage rate moves, that affects monthly payments by borrowers, but it also affects payments received by lenders. And there's only going to be an effect on aggregate demand if borrowers change their spending more than lenders do. And there's 2 arguments why that might be the case. One is borrowers are domestic residents, perhaps some lenders are foreigners, and, you know, we don't care so much about them, and they spend on foreign goods rather than domestic goods. The second argument is that even in a closed economy where borrowers and lenders are all US residents, the borrowers may have a high marginal propensity to consume, or MPC, because they're borrowing constrained, while lenders have a low MPC because they're unconstrained permanent income consumers. Now, it's important to note that the second argument only works if mortgage payment changes are temporary, because if they're permanent, then lenders will adjust their consumption 1 for 1, just the way borrowers will, and there'll be a perfect offset. So both theory and evidence suggest that the mortgage channel is stronger. It works better for adjustable rate mortgages than for fixed rate mortgages. And I'll cite this paper by DiMaggio et al. For some of the empirical evidence on that. By the way, at the end of the slide deck, I've got references, which one can look up afterwards if you're interested. So the three arguments for why this is the case, why the mortgage channel is stronger for ARMs, are on the slide. Number one, ARM payments move with the short rate. Firm payments move with the long-term mortgage rate, which typically moves less because long yields typically move less than 1-for-1 with short rates. Second point is that ARM payments change for all borrowers. Everybody who has an ARM, when the interest rate goes up or down, their payments change. But if you have a fixed rate mortgage, the payments are only going to change for new borrowers who are taking out new mortgages, and on the downside, the people who refinance. And then the third point is that the change in ARM payments is temporary because it's driven by the short rate. The Fed cuts the short rate in a recession temporarily or raises it to control inflation temporarily. But so if you've got an ARM, it's a temporary change in your payment. But if you're reacting to a change in the fixed mortgage rate, that's a very persistent thing because it's a long-term bond yield, basically. So it moves very close to a random walk. And that means that fixed rate lenders will adjust their consumption more, and that will offset the effect on borrowers. Okay, so I've argued that ARMs, ARMs are a good thing if you want a strong monetary transmission channel.
So John, can I just ask a quick question? Yes. It could be that the lenders are still doing short-term lending, and then there's a financial intermediary in between who's doing then the short-term lending. Would this change your conclusion for the last bullet point in the previous slide?
Well, I think the point I would make is that if we look at this last point, we're trying to get an effect on aggregate demand. We need to have a difference between the consumption response of the lender, the ultimate lenders, and the borrowers. There can be, of course, a chain of financial intermediaries in between, but there's got to be some ultimate difference in the consumption response of those who are winning and those who are losing from the change in rates. And if you've got a permanent change in rates, it doesn't matter who's borrowing constrained and who's not. Everybody's changing their consumption 1-for-1, and you get a perfect offset. Whereas that need not be the case, won't in general be the case if you have a temporary change in rates. Okay, now can we even do better than ARMs? Well, there are times when the central bank may want an even stronger mortgage channel than you can get with an ARM. I mean, one example is when the short rate is close to the zero lower bound, as was the case in the COVID pandemic. The Fed could lower the rate up to a point, but it ran out of room to lower the rate. So one thing you can do then is to have a temporary period of forbearance where people don't have to make mortgage payments. And of course, this was done ex post in the pandemic, but it should really be done ex ante in a way that can be priced in and understood in advance by both borrowers and lenders. So I've written a paper with Nuno Clara and Joao Coco, which came out in the Journal of Finance a couple of years ago. And we studied this possibility using a structural life cycle model where we were looking not only at the consumption side of things, but also the default side of things, because of course, the central bank also wants to minimize mortgage default, or at any rate prevent a kind of default crisis of the sort that we had in 2008, 2009. So I'll just show you very briefly a couple of figures from that article. The different colored, let's look at the left-hand bar chart where it says cyclicality of consumption growth. You want these bars to be, you want to find a system that has a low bar, because then cyclical consumption is not very cyclical. It's smooth over the business cycle. And the different colors correspond to different mortgage systems. The first one, which is sort of mid-color blue on the left, that's an ARM. The pink one, the third one from the left, that's a fixed rate mortgage system. So you can see the ARM bar is a little lower, that's great. But then the light blue bar, which is second from the left, that's the ARM with a forbearance provision, which is automatically triggered in a recession. And that's better, that reduces the cyclicality of consumption. The right-hand side panel here, the right figure, is the cyclicality of the default rate. And this is measuring the extent to which defaults happen in recessions. Again, you want a low bar. You don't want to have a lot of defaults in recessions. Again, the ARM mid-colored blue bar is lower than the pink fixed rate mortgage bar, because lower rates in recessions help stave off defaults. But you can do much better if you have forbearance in the recession, because then people are not going to default in the recession. They're not having to make any payments. And in fact, the defaults tend to happen when you're outside the recession, when you have to start making your mortgage payments again. And that's why the light blue bar is actually negative in that figure.
That's the default of the households. Does it also include the defaults of the banks?
That's the default of the households, which of course then passes through to the mortgage lenders, who might or might not be banks. We'll get to bank balance sheets in a little bit.
Okay.
That's obviously an important issue. So then one can look at the cost. You don't want to cook up some system that is so unattractive to lenders that the rates will be very high. The left bar chart on this slide is showing you the loan premium, the spread over the equivalent treasury rate that is charged by lenders. And basically, arms firms and the forbearance arms all have fairly similar costs. The forbearance arm is actually even a little cheaper because lenders like the fact that defaults don't happen in recessions. And then the right bar chart here is showing welfare gains, where you look at the welfare of borrowers and lenders, and the light blue bar at the left shows that this forbearance provision is welfare enhancing. So I think there's a case for doing this, which we did. Again, we did it ex post in the COVID pandemic, but it would be better to set this kind of system up in advance.
Just to understand the welfare gains, that's always relative to the baseline.
The baseline, that's relative to the baseline ARM system. And actually this illustrates—
everything is relative to baseline ARMs, or is it?
Yes, in this paper, the ARM is the baseline. So the positive pink bar in this right panel is showing you that actually borrowers, they do like fixed rate mortgages, but they like even more an ARM with this extra feature that in a recession, they'll be given some forbearance. Okay, so that's the mortgage channel of monetary transmission. Let's go on and talk about inequality. And I think this is really an important—
Before you jump to that, would you also say that the interest rate movements of the Fed is hence more pronounced because we have this mortgage system? Because you have to hike this.
Yes, it may well be that the Fed then has to move the rate more to achieve its goals, more and in a more persistent manner. And of course, we've just emerged from a period when the Fed was relying very heavily on forward guidance, which has now, in a way, come back to bite the Fed, because the Fed made strong statements about what it would do and has now done something else because circumstances have changed. One reason why the Fed had needed so much forward guidance is they were needing to try to move longer-term rates, longer-term mortgage rates. Okay, so that's a great question, Marcus. Thank you. Okay, so let's talk about inequality, refinancing and inequality. So let's ask, who refinances? When rates go down, who refinances? Well, in the US, refinancing requires positive home equity and an adequate income and credit score. So what does that mean? When the Fed faces a recession and cuts interest rates, the impact is weakest in regions with depressed home prices and high levels of unemployment. So the mortgage channel of monetary transmission is weakest exactly where we want it to be the strongest. And I think that's an important objection to this type of system. The second point is that refinancing, even among people who can refinance, the extent of refinancing varies with the sophistication of borrowers. Now, we can measure this effect very precisely in Denmark, because in Denmark, everybody has an absolute right to refinance. So if people don't do it, you know it's that they forgot to do it or didn't know they could. But the effect is also important in the US, and some recent work by Girardi, Willen, and Zhang suggests that it helps to explain troubling racial differences in mortgage rates paid by Black and white borrowers in the US. So let me show you a couple of figures. This figure shows something called refinancing efficiency using Danish data. This is taken from the paper that I've published with a team of co-authors in the AER in 2020 based on the Danish mortgage system. And the figure shows something called refinancing efficiency, which is basically in our sample period, which is a declining interest rate period, how much money did you save by refinancing? And what is that as a fraction of what you would have saved if you'd refinanced optimally following a particular academic model of optimal refinancing proposed by Agarwal, Driscoll, and Leibson. So the benchmark, the 100% benchmark, is following the advice of academic economists, and people don't do as well as that. But on average, they in this period got something like 2/3 or 70% of what they could have got. But what this figure shows is that when you sort households by their rank and you divide them into quintiles, on different characteristics, age, education, income, financial wealth, and housing wealth, the pattern you see is that refinancing efficiency is higher for people with more financial wealth, bigger houses, more education, and more income. In other words, wealthier and more sophisticated people. And it's lower for older people. So that means that there's a big difference. Some people are leaving a lot of money on the table, and those people tend to be people with lower education and socioeconomic status.
How would you explain the age phenomenon that older people? Is
Well,
it because it correlates with sophistication?
There's a little bit of a hump shape in age. The age line is the one with X's, and it's a bit of a hump. We often see a hump in age in household finance. There's a very nice paper by Agarwal, Driscoll, Gobex, and Leibson called The Age of Reason, which points out that middle-aged people tend to do best. And they argue that that's because the young are inexperienced and then older people are in cognitive decline. So the youngest people and senior citizens tend to be doing worse. And I think, this pattern is roughly consistent with that. Now, here I want to show you a figure based on US data. This is taken from the Girardi, Willen, and Zhang paper. And look at the red line and the blue line. These are interest rate differences on mortgages paid by Black borrowers and white borrowers in the US. The red line is the difference in the rate paid on newly originated mortgages. So it's about 15 basis points on average, and that can be explained basically fully by characteristics that are relevant for mortgage pricing. So federal regulation is pretty good at preventing racial discrimination in mortgage lending today, and so that's the red line. But what's the blue line? The blue line is the difference between the rates paid by Black and white borrowers on the mortgages they actually have at each point in time. In other words, instead of the flow of new mortgages, which is the red, the blue is the stock of outstanding mortgages. And you can see that that blue line is higher on average, and particularly high towards the right of the figure, which is the early 2010s. And in general, the blue line tends to go up whenever rates fall. So the dashed black line at the bottom of the figure is a measure of the underlying shadow Fed funds rate. It can go negative. It's calculated to avoid the zero lower bound. So it's a measure of sort of where interest rates are. And when interest rates fall, that's when you want to refinance. But what happens is white borrowers do that more than Black borrowers. And so this blue spread widens. And in the early 2010s, it was 50 or 60 basis points, which is really enough to be a very troubling finding. Okay.
So there's one question by Josh here. So you used the Danish as an example. There's also an FHA and VA mortgages where supposedly refinancing is very streamlined. Have you looked at these data as well, just to contrast it with the Danish?
I haven't looked at those data, but there are studies of US refinancing decisions. For example, there's a paper by Keyes, Pope and Pope, where they look at a sample of pre-approved mortgage refinance offers and who takes it up and who doesn't, and you find similar patterns. So in equilibrium, what is the effect of this? Well, it's a cross-subsidy from the poor to the rich. Okay, so why is that? Well, in a competitive market, the extra revenue that mortgage lenders get from non-refinancers who are paying more than they need to, that extra revenue is partly passed on through the competition for borrowers in the form of lower upfront mortgage rates. And that implies that sophisticated refinancers, all of us on this webinar, we get a cross-subsidy by pooling with non-refinancers. This is an example of what my colleagues Gebex and Leibson have called shrouded equilibrium. I don't know if there are any fans of Monty Python on this webinar, but I grew up watching Monty Python, and I think of it as a Dennis Moore equilibrium. And I'll leave the reference to resonate with those who remember it. But basically, we're taking from the poor and giving to the rich. We're taking from less sophisticated people and benefiting more sophisticated people. What it also means is that it's harder for innovators to introduce new, easier to manage mortgages. I mean, imagine coming in with an automatically refinancing mortgage, which could save a lot of transactions costs and be very easy to use. Well, that's going to be expensive for anybody sophisticated, because if you take out that mortgage, you're going to lose the benefit of the cross-subsidy. But it's the sophisticated people who are the natural early adopters for a new product. Unsophisticated borrowers aren't going to understand the new product or know why they need it. So, you know, we can get stuck in an inferior equilibrium.
So, John, you know that the Wall Street is doing a lot of these prepayment models. One could imagine that some mortgages are sold at cheaper interest rate to the less sophisticated households. So if I know this is a less sophisticated household, he will not refinance. I might give him a lower mortgage rate. Do you see that, or?
Well, this is the strange thing, and I think that there should be more research on this. We don't actually see separation of mortgages into pools by sophistication or race, for that matter, and therefore we don't see unsophisticated borrowers benefiting in the form of lower rates up front. There's a pooling equilibrium. Now, it is a little bit of a mystery why that is, but that's what we seem to see in the data.
But the innovation could happen there.
It could happen there. That's a very, very good point. Now, I want to focus for a minute on another aspect of this, which is I think understudied, and that's the fact that we have these mortgage points. And you know, what are points? If you haven't sort of taken out a mortgage recently, you may not know about them. So what I've put on the slide is a table of a rate table. So the rates are shown in the left-hand column, and then the numbers in the body of the table are the closing costs that the borrower has to pay to the lender as a percentage of the mortgage principal. They can be negative, which is true down at the bottom of the table, and that means that the borrower is taking a little bit of more money from the lender to cover other costs of doing the transaction. And essentially what we see in the table is that if you borrow more, in other words, if you go down to these negative numbers in the body of the table, you can do that and pay a higher rate. The numbers in the left-hand column get bigger as you go down. So that's the system. And I want to emphasize, this is weird. This is completely weird. Why? Because in textbook finance, the interest rate is a single number that's given, you know, you get it from the bond market. It is what it is. If you borrow more money, that increases the size of your debt, but it doesn't change the interest rate. In the point system, when you borrow extra money to cover these closing costs, It leaves the face value of the mortgage, the size of your debt, unchanged, but increases the interest rate. Well, now you might say, look, it doesn't matter. Either way, the required monthly payment goes up. You're just multiplying a rate and a principal balance. Doesn't matter where you put the numbers. But there is a difference because you're allowed to refinance. So if you take points, if you borrow extra, promise to pay a higher rate, you may not have to pay that higher rate for very long because you'll be able to refinance out and walk away with the extra money that you borrowed. Now, the paper by David Zhang, former Harvard PhD student, now teaching at Rice, explores the effects of this system. And what he shows is that many of the borrowers who take points to cover closing costs are sluggish refinancers. So they promise to pay this higher rate, and then it would be in their interest to refinance, but they don't do it. That actually lowers the cost of taking points for prompt refinances. So it worsens the cross-subsidy problem. And he calculates that in an equilibrium with points calibrated to the 2010s, there's a transfer with an average present value of about $10,000 for each mortgage from non-refinancers to prompt refinancers. And furthermore, because in this system, the savvy thing to do is take points and then refinance. That's what people on this webinar will probably do. You'll get extra refinancing that otherwise wouldn't have happened. The problem with that is there's real resource costs from refinancing. He estimates about $1,400 for each. For each new mortgage origination at the time of a house purchase. So this is, it worsens inequality, and it's actually an inefficient system. Now, finally, I will mention that this problem is not just a fixed rate mortgage problem. It is, in this country, it's a fixed rate mortgage problem, but you can have similar problems in ARM systems too. So in the UK and many other places, including Canada, ARMs are marketed with teaser rates that you get a low rate up front, and then after 1 to 5 years, the rate jumps up to a much higher standard rate. Well, what do sophisticated people do? Of course, they refinance, jumping from teaser rate to teaser rate, and that leaves the unsophisticated people to pay the high rates. And again, you get this transfer from the poor to the rich, or from the unsophisticated to the sophisticated. That problem was pointed out almost 20 years ago in a report on the UK mortgage system by David Miles, and a recent paper looking at UK data documents that the transfers continue, and they continue to go from poorer to richer mortgage borrowers.
So John, can I ask you a quick question? So it could also be that the less sophisticated people are overconfident how sophisticated they are, in a sense. Yes. Has anybody done some survey where the behavioral bias is coming in? Or is it like they're overconfident how quickly they have to move again and reoptimize anyway? What drives essentially this?
I agree with you that I think sort of surveys of mortgage borrowers to figure out what they know, what they're thinking about, what they anticipate would be very worthwhile. I haven't seen much evidence on that. But I also agree with you that there's a general tendency in household finance for people to think that whatever's familiar is safe and straightforward. And very often what's familiar is, risky and surprisingly hard to manage. So, the stock of your employer is a very risky retirement investment, even though it's familiar. And a plain vanilla US fixed rate mortgage with points is very familiar, but also surprisingly hard to manage. And people, I think, don't realize that. And in that sense, they're overconfident. So
I forgot to, there's some questions in the Q&A. Some people would like to know, you mentioned the African Americans versus whites. Did you also look at Asians versus whites in the refinancing rates? No, I'd have to look back at the paper. The main focus is on black and white borrowers. I think they also look at Hispanic borrowers, and I don't remember whether they have evidence on Asian American borrowers. Okay.
Well, now let me just quickly talk about two more problems. Let's talk about fixed rate mortgages and financial stability. Obviously, very salient topic right now. So, fixed rate mortgages are long-term fixed income securities. And so they create maturity mismatch when they're held by banks that are deposit financed. And that was the undoing of the savings and loan industry back in the early 1980s. Now, of course, since then, we've developed a securitization system which is intended to solve this problem by passing mortgage interest rate risk on to MBS investors. But I think what we've learned over the years is that that system works imperfectly, partly because the origination process requires banks to hold mortgages while they're in the pipeline, but also because some banks like to buy MBS to earn a term spread. That's what First Republic was doing in many cases. Now, ARMs don't create this problem, of course, and that's one reason why they're common in countries with deposit-financed mortgage origination. There are other solutions. In Denmark, they use covered bonds, for example, but this financial stability issue is, I think, pretty important in this country. Now, it's a little more subtle than that because we have refinancing, right? So that refinancing speed is somewhat random. There's variation in refinancing rates that's unrelated to the level of interest rates. This creates prepayment risk, which cannot be hedged in treasury markets and is priced by MBS investors, and is a major topic of sophisticated quantitative modeling on Wall Street. So it's ironic that the least sophisticated participants in the financial system, home borrowers, mortgage borrowers, by their random behavior, create a source of risk that then is a headache for the most sophisticated players. Now, of course, beyond that, interest rate movements also alter the duration of MBS, and this creates shocks to the supply of duration that destabilize bond markets and banks. So it's not just that firms have long duration, it's that they have variable duration. What happens when interest rates go up? Well, refinancing goes down, so the duration of fixed rate mortgages and fixed MBS gets longer, and that contributes to the problems of banks like First Republic that have a large mortgage portfolio. On the other hand, if interest rates goes down, that stimulates refinancing. If the refinancing happened instantaneously, then the refinancing option in the mortgages would restrike and the duration of mortgages would be restored. But actually it happens slowly. People refinance sluggishly. So when interest rates go down, there's a temporary reduction in the duration of fixed rate mortgages and the overall supply of duration in the bond market. So my HBS colleague Sam Hansen documented this fact a few years ago and showed how it moves bond yields. So, here we are. We're in an environment where rates went down for a very long time. Look at the red line, and they've just recently shot up. So a long-term trend has reversed. That's the world we're in now. But we can see that movements in interest rates, in this figure taken from Sam Hansen's paper, movements in interest rates bounce duration around. So the blue line here is the aggregate duration of the overall bond market. And if you just had a sort of stock of treasury bonds sitting out there, that blue line would be flat. It's not flat. It moves up and down. And the reason is the contribution of MBS, because mortgage duration is always shifting with refinancing behavior. And you can see that because the red dashed line is what's moving the green line around. Okay, so, finally, what does this
John,
mean?
can I ask you,
yeah,
if you were to have automatic refinancing, you would prefer that, or you would prefer an arms arrangement? And can you contrast a little bit the US versus UK, because there are many similarities in the financial sector, unlike in Denmark. But this is one striking difference. Or we will come to US versus UK.
Absolutely. I mean, automatically refinancing mortgages would somewhat mitigate the duration shocks that I just showed you, but they would leave you with the problem that fixed rate mortgages have generally long duration, and they'd also leave you with the problem that that duration will tend to rise as interest rates rise, amplifying the problem for the bank balance sheets. On the other hand, if you have adjustable rate mortgages, then, deposit financed institutions can match liabilities and assets pretty easily. Now,
so would you also say it depends also on the market power of the banks on the deposit side, where this interacts as well?
Yes, I mean, there are definitely some subtleties here because, a bank that has a very stable deposit franchise where they can just pay a zero interest rate and just sort of sit there, that is a kind of a long-term liability, and you might choose to match then a long-term asset. So we've become very aware of this year, that the flightiness of the deposit base is a sort of important state variable for banks. But let me go back to the sort of implications for monetary policy for one moment. By encouraging maturity mismatch in the banking sector, I think these firms make life hard for the Fed when it needs to raise interest rates to combat inflation. So the risk of financial instability is certainly limiting what the Fed can do right now. If you have an arms system, that's going to put the burden of rising rates on households, which is perhaps where you want it to be, because that's how you're influencing aggregate demand. You may indirectly stress the financial system if you cause a wave of defaults, of course, and that's something you have to think about. Okay, now finally, let me quickly talk about lock-in.
Can I just raise another more general? So you focused very much, all the rates you showed are nominal rates.
Yes.
Did you also take inflation into account at the real rates? Because it might vary a lot whether you're in a stagflationary environment or in a booming phase where it's due to high demand shocks. And I know you worked a lot in that space as well. Does it have implications also on your mortgage design? Whether it's supply shock or demand shock?
If we zoom out and think about the risk of really severe inflation, another way to look at this is to say nominal fixed rate mortgages are a very strange instrument because they are a massive one-sided bet on inflation. Home borrowers are going to win big if inflation gets out of control. So people who bought houses and took out mortgages in the 1950s and 1960s, they won the lottery, right? Inflation wiped out the real value of their mortgage debt, and they were left owning the houses, and they did very well as a result. Of course, you have to pay for that one-sided bet, that option. You have to pay for it up front in the form of higher mortgage rates. This is one reason why countries that have a history of volatile inflation, places like Italy, even the UK, they tend to not have long-term fixed rate mortgages because those things would be too expensive. And that's one reason why they shifted to these adjustable rate mortgages. So, of course, an answer to that would be to inflation index mortgages. But alternatively, we can just have a Fed that's very credible and very good at controlling inflation, and then we don't need to worry about that side of things. Well, let me talk now about lock-in briefly. So, in a rising rate environment, a borrower with an old fixed rate mortgage is going to be reluctant to move, because if you move, you're going to have to replace your cheap mortgage with an expensive one. And this can reduce liquidity in the housing market and also prevent people from moving to take better jobs. Now, in recent decades, we haven't worried about that because rates have been falling all the time, almost all the time. But it's newly relevant this year, and it's in the news. Just this week there was an article in the New York Times emphasizing this point, and there's an illustration of the lack of liquidity in the housing market. People don't want to sell. The three people on the left of the cartoon, they don't want to sell. Now, lock-in can actually affect moving even if rates don't literally go up. And the reason is that because there are fixed costs of refinancing, you don't want to refinance a typical mortgage until the currently available firm rate is about 1.5 to 1.8% below the old rate. Moving, of course, forces a new mortgage origination, so you pay a fixed cost to get a new mortgage rate. And that means that the difference between the old rate that you give up and the new rate that you take on does affect the overall cost of moving, even if the new rate is below the old rate. So there's a very nice new paper on that by Fonseca and Liu, which is a working paper. And this is showing the horizontal axis here is what they call the mortgage delta, which is the difference between the old rate and the new rate. People way off at the right are people who are not paying attention and should already have refinanced. But everybody to the left of about 1.8 or 1.5 are people who may or may not be moving, but what you can see is the moving rate, which is the vertical axis, increases with that mortgage delta. And if rates are rising, you're going to be way off at the left in the negative region of the x-axis. You're going to be way down at the bottom left of the figure. And you can see that does have a measurable impact on the moving rate. So how big a deal is that? This paper estimates that a 1 percentage point rise in mortgage rates lowers the annual moving rate by about 70 basis points, which is about 9% of the average moving rate. And then they do a rather speculative longer term forecast using forward rates to suggest that over the next 15 years, you could see a 1.9 percentage point decline in the moving rate, which would be about 25% of the base moving rate. Now, labor market effects are harder to estimate, but with that level of immobility, they could be quite substantial, and you could have a labor market that's kind of gummed up because people are not willing to move to new and better jobs. Now, there's various, yes.
Can you just, of course, it also has implications on the housing supply, as you have shown it. So it might smooth or reduce the volatility of house prices. Now, if we go in this cycle, interest rate goes up and housing supply dries up because of these moving frictions, and we go more for renting, it might stabilize house prices, which ex ante might lead to more house bubbles because it's less likely that house prices go down.
Yes,
you see the connection? I have to look also in house price volatility, essentially.
Yeah, the problem is not so much the price effects as the allocation, the actual matching of people to houses. But you're right, there could be interesting effects on prices. Of course, the New York Times article that I linked there was arguing that house prices are being propped up by the reluctance of people to sell. But the Fed is trying to slow down the economy. So perhaps the Fed, wants to limit house price rises. It may be a bad side effect. Anyway, if you want to fix lock-in, there's lots of ways to do it. I mean, most obviously, ARMs don't have lock-in, but assumable mortgages don't have it. Portable mortgages don't have it. Or the Danish system doesn't have it. I mean, any of these are solutions. And they all avoid the distortions that are created effectively by privileging non-movers over movers. Economists are used to, we naturally object to things like rent control systems that adjust rents only when tenants leave, or property tax systems that adjust valuations only when properties are sold. We recognize the friction that creates. And I think our mortgage system is a little similar. And so I think this is an issue. Now,
can I ask, so why is this, why are we locked in? Or you will explain us why we don't see corrections, that the free market is not providing instruments to solve these problems?
Yeah, I mean, some of the effects I've been talking about are externalities, sort of policy issues, monetary power of monetary transmission mechanism is not something that individual mortgage borrowers are going to think about, nor are they going to worry about the stability of the banking system. Others involve, consumers who don't anticipate properly. I mean, we talked about the overconfidence that people perhaps have, or their failure to understand how to manage a mortgage. So these are all reasons why the free market may not solve the problem. Now, I know, time is limited. I've got a few things to say about consumer preferences and then some policy suggestions. Do I have time to do both of those?
Yes, we go a little bit longer.
Okay. All right. So, I've been talking without regard to what borrowers actually want, but it's natural to ask, well, what do people want? So one obvious point is that, when when the spread between fixed and adjustable rate mortgages moves around, people do react to that. Interest costs do matter. And one of the reasons why people like ARMs is that when the short rate is below the fixed rate, it's cheaper initially. If that yield curve inverts, that will tend to push you the other way. That's not surprising. But what about the cross section? So who's doing what? Now, it's well known that in the US, the ARM share is higher for subprime mortgages and jumbo mortgages, and it's lower for so-called conforming mortgages, which have prime borrowers and where the mortgage is not too large. Now, that's often attributed to the implicit government subsidies to these mortgages that are provided by the activities of the GSEs, Fannie Mae, Freddie Mac, and so forth. They provide credit guarantees and they securitize conforming mortgages which are fixed, and that may lower the rates. And on this interpretation, the cross-sectional pattern is evidence of a distortion in the mortgage market. What I want to say is that research I'm doing now, looking at Danish data, shows very similar patterns there. But in Denmark, there are no GSEs. There is no distortion, so the reason must be different. So in this work with Andersen, Kokko, Hansman, and Ramadari, what we find is that the ARM share in Denmark is higher in two very different kinds of groups. Young borrowers, first-time home buyers, they have low financial assets. And then the other group is middle-aged borrowers with large houses and large financial portfolios. And what we think is that ARMs are appealing differently to these two groups. The first group is borrowing constrained, and they just want a low current interest rate, which will permit higher current consumption. They're aware that rates may go up in the future, that's the risk they take, but they believe that their income will be higher by then and they'll be able to handle it. The other group are middle-aged households with large houses and large financial portfolios. And they, we believe, are using ARMs as a cheap form of leverage. If you're an individual and you want to lever up, collateralized borrowing against your house is the cheapest way to do that. And an ARM is typically cheaper than a firm. And in effect, what you want to do is borrow at the short rate and then buy bonds and stocks. Now, if rates go up in the future, these households can always optimally delever. They can actually pay off the mortgage if they need to. So they're not concerned about interest rate risk in the same way. So I've got some slides with evidence on that, but I think maybe it would be more interesting to the audience to skip those slides and go to my policy suggestions, and then we can see what questions and comments.
We can go another 10 minutes. It's up to you.
All right. So this is just showing that this is just some evidence from Denmark. The left panel shows that people with ARMs are more likely to move. That makes complete sense because they only care about the current rate if they're going to move. The right panel shows that the poorest people and the richest people are the most likely to use ARMs. And then if we can look at a multivariate analysis, we can see that people with big mortgages on the left and tend to use ARMs. And the effect of financial assets to income is U-shaped, which is these two groups, the people with almost no financial assets who are constrained, and then the people with big financial portfolios who are using ARMs to lever. Okay, so let's pull it all together and let me leave you with some thoughts about policy. I've got 3 slides on that, okay? So first thought is, different countries have very different mortgage systems, but the nature of these systems is highly persistent over time. So if I come on Markus's Academy and I say, let's radically change the US mortgage system, that's pie in the sky. That's just not going to happen. These things do not change quickly. There's both political resistance to institutional change. Look at the fact that the government still is running the GSEs, even though they were taken temporarily into conservatorship 15 years ago. And then there's borrower resistance to novel mortgage products. So things change slowly. Having said that, I think the traditional US fixed rate mortgage does not deserve the strong political support that it's received in this country. I think the US might be better off if our system were to shift, no doubt gradually, in the direction of, say, the Canadian system, where mortgage rates are fixed for only 5 years, not 30. monetary policy would be more effective, and the banking system would be more stable. Now, here are some more thoughts. I think we learned in the COVID-19 pandemic that mortgage forbearance in a recession can be powerfully stabilizing. It relieves household budgets, it stimulates consumption. But it would be better to build that into mortgages ex ante and price it with explicit provisions. Another point is refinancing options, which we take for granted in our system, they're hard to manage and they benefit sophisticated borrowers at the expense of lower income, unsophisticated borrowers. So I would say that mortgage policy should favor either plain vanilla ARMs, no teaser rates, or automatically refinancing fixed rate mortgages over traditional fixed rate mortgages. Wherever possible, we should lean in those directions. Now, I particularly want to criticize points. I think it's a particularly pernicious system. So we could easily change the system such that if you borrow your closing costs, you increase the mortgage balance in a way that could be excluded from LTV limits, but then would not change the interest rate and would not create this incentive to refinance. So that's perhaps low-hanging fruit. If there's something sort of feasible that I'm suggesting, it would be to do something about points. It's just a bad system.
So do you think the LTV limits are the primary drivers of this point system?
Well, what many people do is they go up to say, you know, an 80% LTV, or some threshold level of LTV. There's a lot of clustering there. And then they may need a little more money. They borrow the closing costs using points. What I'm suggesting is that you could have the borrowed closing costs add to the loan size, but in a way where you relax that LTV very slightly. I also think that we should concern ourselves with lock-in. I think policy should favor mortgages that don't lock in. That means either ARMs, assumable mortgages, or portable mortgages, basically, within our system. And other countries have these. You know, in Canada and the UK, mortgages are normally portable. So we could do it too. Finally, this is my very last slide. I hope it's been clear from these remarks that, you know, we can't assume that the mortgages we have are the best that can be designed. There's a lot of historical accident in the type of system that we have. There's many weird features of the system. I think policy should try to make space for innovative mortgages. And there are some things I haven't really discussed. So, for example, inflation indexation of principal. There are often rules against negative amortization, but if you have such rules, it should be a rule against real negative amortization. You should certainly allow nominal negative amortization. You may also want to index principal to home values, shared appreciation mortgages, which are, you know, there's a lot of new mortgage lenders in the fintech space who are beginning to offer these types of contracts. And I think we want to allow experimentation to take place. A useful concept is that of the regulatory sandbox, where you have a light touch for new products that have a limited market. Of course, if these products start to take off, then you're going to have to move them out of the sandbox and into the main playground, and then you may need to regulate them more carefully.
So this reminds me actually of Bob Schiller's push to have this macro markets and also the, you know, having them indexing of their mortgages based on how the shared mortgages. Is this? Yeah.
So I mean, it's a really interesting question as to whether who is it that should bear house price risk, right? And should that be investors, deep-pocketed investors, or should it be actually homeowners? And the ambiguity is that if you're living in a house for a long time, the house price variation, the house actually hedges you against rent risk. It may not be risky in the relevant sense, and in that situation, the homeowner is actually the natural holder of the house price risk. Of course, that's not true if you're going to be downsizing or moving to another area with uncorrelated house prices. So there are many subtle issues there as to whether and how much homeowners should transfer the house risk to lenders. But I certainly think we want to allow some experimentation in this space.
So let's suppose we go for some of these regulatory changes or these new innovations. I guess for each innovation, there will be a transition phase. You probably can't just do it immediately. And now there are certain changes where we would say the transition phase has to be much longer, 10, 15 years, and others we can introduce in a 2-year transition phase.
Well, I would have thought, again, I was sort of beating up on points, and I think that that's a system that one could reform quite rapidly, you know, and with minimal disruption, actually. Other things might take longer.
So after the global financial crisis, there was this huge wave. Everybody wanted to adopt the Danish system, and you also contrasted very much with the Danish system. Would you use very much in the favor of the Danish system as well, putting everything together?
I would say that the Danish system is, it fixes many of the problems with the US system. Mm-hmm. So for example, you don't have lock-in in Denmark. You don't have people frozen out of refinancing because they've lost their job or their house price has fallen. That's a good thing. However, the Danish system still relies on discretionary refinancing by the borrower. It's not automatic refinancing, and so you still get these inequalities, which I showed you. The funding system is good because it's this covered bond funding mechanism, which ensures that you really do pass the interest rate risk through to end investors who are well positioned to bear it. So it's good from a financial stability point of view. I would say if you could take the Danish system and make the refinancing more automatic, that would be the best possible fixed rate mortgage system. There's still a question, though, as to whether it's as good as a more adjustable system, which would have a stronger monetary transmission mechanism.
So let me just the final question. So thanks a lot for a very insightful talk and very, laying out the groundwork for many policy changes here. Come back to the inflation thing. So you made a very important remark earlier that is saying countries which experience a lot of high inflation or volatile inflation went more for an adjustable rate mortgage system. Can I turn it the other way around? The fact that, that I have this adjustable rate mortgage system might induce the central bank then to allow more inflation volatility. Can it go both ways? And the fact that if I don't have this, the Fed or the central bank is more concerned about inflation volatility and has to control it, therefore, because it causes more distortions in the real side.
I don't think, in an arms system, inflation volatility really does bite on households in a very fundamental way, because when inflation goes up, what happens is inflation is eroding the real value of the mortgage, and the lenders are compensated for that by the interest rate going up. Now, the mortgage is, if you like, a floating rate note, so it has a stable capital value. That's all good. The problem is that borrowers are in effect being asked to repay more quickly when inflation goes up. Now, if they're unconstrained, they can just adjust other borrowing and it's all fine. They can smooth it all out. But if the borrowers are borrowing constrained at the time when inflation goes up, it really hits their budgets. Now, the central bank may like that. That may be slowing down the economy, which is what the central bank wants to do. It can be very painful for borrowers. And certainly there are political implications. I grew up in England, went to college in England, and my cohort of friends, all moved to London and all bought houses and all had families in the 1980s around the same time. They took out adjustable rate mortgages. And then in the late 1980s, the UK government lost control of inflation a little bit, and rates shot up and house prices fell. Mm-hmm. And, my generation of college friends were all stuck with a big hit to their household budget. That, of course, slowed down the economy very effectively. So monetary policy worked. but it was a very painful experience, and it was very politically difficult for the government. It may, you know, it put a lot of pressure on the government to improve the conduct of monetary policy and not to do that to the population, which then, of course, led to the experimentation with the European exchange rate mechanism, and you know, then that ended in tears, and then later in the 90s, the Bank of England was made independent. So I think I would argue adjustable rate mortgage systems, you know, monetary policy is effective, but it's also becomes a very politically difficult thing because a very large swathe of the population is having their budgets directly affected by what the central bank does.
I guess we saw it also last year when the gilts was jumping because of the LDI crisis, and suddenly the mortgage market froze for a few weeks.
Yes.
Okay, so it's of first order importance. I think it's probably very important that, you know, giants like you study this very carefully, and I guess we have to have further insights, and I hope that you will push the US mortgage market in a better direction, and you know, with the transition phase, we can end up with a better mortgage structure in the US, but also in other countries.
Thank you, and I hope that, you know, the large audience for this webinar series will carry on both the research and the policy advice.
Thanks a lot, John. So I really appreciate it, and I would like to invite all the viewers to also attend next week, where we talk about how we can use ChatGPT for economic research. So you will learn a lot of tips and tricks how to better use it with Kevin Bryan, who is an expert on ChatGPT. Bye-bye, and thanks for joining us. Bye-bye.